Hello everyone, welcome to today's US Open live webinar. It is Tuesday, October 17th, 10 minutes before Wall Street opens. As always, I'm your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. Just earlier, we had strong retail sales figures from the US, which gave the US dollar and US yields a boost. In an overall eventful week, we continue to monitor, of course, the Middle East conflict, and there are key events ahead, including UK inflation update. Of course, we also have earnings season in full deploy and key reports coming in from Netflix and Tesla on Wednesday. So that's pretty much what we will be talking about today. But before we begin, as always, please read carefully through the risk warnings and the disclaimers, and then we will get started. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed here does not constitute investment advice. We're going to give it a few more seconds, and then we will begin. Okay, let's get the ball rolling because we have quite a few things to cover in a very eventful week already and in the coming days. So we're gonna start with Euro USD and talk about today's reports from the US. And then we're gonna discuss the Middle East conflict and the impact on oil prices. We're gonna then move to the Nasdaq, and then we're gonna discuss Netflix and Tesla ahead of their upcoming results on Wednesday. We already have a video preview of Tesla and written review of Netflix if you want to look more into that. And we're gonna round things off as always with what's ahead, and there are key incoming releases, including UK inflation tomorrow. So let's talk a little bit about the releases from the US. We had a few issues with the sound. So we're gonna start from the top. I'm not sure for how long you couldn't hear me, but we're gonna start with the retail sales came in at 0.7% for September, elevated, and the control group, which is used in the PCE calculations, jumped 0.6%. And those figures showed consumer strength and lifted yields, 10-year yields and the US dollar. But the subsequent industrial production report was on the soft side and takes some of that effect away. Now, in terms of Euro USD, not much has changed. It does find some reprieve this week, but remains in a precarious position. The bearish bias is intact, despite the softening Fed rhetoric. And Euro USD is still vulnerable to new 2023 lows, current at 1.0447, although further drop below the next support at 0.0337 has a higher degree of difficulty. Given this week's actually effort to recover, we can see another push towards the critical region of 10.65, which is the 200 period EMA, and the 23.6% Fibonacci, for which we have talked again about. Successful closes above that could propel it to the next resistance at 1.0763, and again critical technical level, but it does not inspire confidence for a meaningful recovery under current conditions and policy differential. Again, these are all things that we discuss pretty much on every session. But just to recap, the bearish bias is intact and the upside is hostile. However, we expect more events over the following days, including a speech from Mr. Powell, so this could determine the next leg of the move. Now let's turn over to US oil. So oil prices have been volatile but profitable last week after the Hamas-Israel war erupted. So, of course, Middle East is an important oil hub and energy hub, and the events there set back efforts to improve the relations between Israel and key Arab states such as Saudi Arabia, one of the world's top oil producers. Iran is also another aspect of this equation and an important oil producer too. There are restrictions on its oil supply, but Washington seems to have been turning a blind eye because to the increasing production, because that helps keep prices lower. But the new developments could lead the US to a more forceful stance and make any lifting of those sanctions much harder. Now, on the other hand, Iran has denied any role in the attacks, and Washington has not disputed that. They have said that there's no direct involvement found, at least yet. Israel, although preparing to enter the Gaza Strip, has not done that. If it does enter, it could sort of harden the stance of the Arab nations, but has not done that yet. And so far, the spillover to the broader region is contained and avoided. So these events will be critical for the oil market based on how they evolve, but these are some key considerations. Now, US oil is cautious this week, but an escalation, of course, could provide a further lift. It trades sort of around the 200 period EMA, so there's a mixed outlook, but given the situation, and as long as it stays above the EMA 200, bullish bias is maintained and there is room for new highs towards 95 per barrel, but we are cautious around the $100 barrel narrative. However, as we said, it is mixed, and the situation so far in the Middle East is a bit contained. So there is risk for a pullback towards 77.57, although there is the daily smoke cloud intervening there. But in any case, sustained weakness is hard given current conditions and developments. And now let's turn to the Nasdaq, which drops after the strong retail sales figures earlier today, but it awaits Netflix and Tesla. We're going to talk in a bit about that. And of course, Powell's speech later in the week that will likely determine its trajectory. Again, a bit of a mixed situation here. So investors will try to find hope in the upcoming earnings. It remains to be seen if those can lift the tech-heavy index. Given Middle East developments and prospects of higher for longer by the Fed, it is in a bit of a tough spot, and we could see further pressure towards 14,500, we would say, and from that level on, however, there are multiple roadblocks. On the other hand, there has been a soft rhetoric from Fed officials, Fed voters recently. We have already talked about that, and that has helped the index overcome those Middle East jitters. The road to new 2023 highs at 15,946 is not closed, but it will need some help either from the upcoming earnings of the tech sector or from other factors to push towards those levels. Okay, now let's talk about Netflix and Tesla, both of which report their latest quarterly results on Wednesday after US close, and both of them saw their stocks facing pressure in the third quarter, but overall have a very good year. Once again, you can find a video on the top of your screen around Tesla, and you can find Tesla's upcoming earnings, and you can find written analysis around Netflix on the FXCM market analysis website of your respective regions. Now, the EV sector faces weak demand, as we see Tesla on our chart, and this was evident to the Q3 delivery figures, which are already out and showed a decline, a sequential decline for the first time in over a year, despite a series of price cuts. The recently refreshed Model 3, of course, can help, but the Cybertruck, the long-awaited Cybertruck, remains elusive. Those price cuts, of course, have led to lower profitability, which could continue given the delivered drop and lower prices. Margins may still be better than most major auto giants and, of course, startups, which are generally unprofitable, and markets appear cool still, but if they persist, concerns could begin to mount. Tesla's AI push will also be in the spotlight during the earnings call, because this can help it with autonomous driving and other aspects of its business, which can unlock significant value. In terms of the stock, as we said, Q3 was underwhelming, but it defended the 38.2% Fibonacci of this year's rally and retains the upside bias as long as it is above that level and the 200 period EMA. On the other hand, it faces various challenges that could create pressure and lead to a return below the 200 period EMA, as we said, although sustained weakness does not look particularly easy at this stage. Now, in regards to Netflix, the streaming pioneer changed key aspect of its business with new password sharing policy and an ad-supported tier, which helped it reach new record revenues and ad subscribers in the second quarter. At the same time, its main streaming competitor Disney is struggling, although it faces increasing competition from tech giants such as Amazon and Apple. Markets are still a bit weary despite the good results because revenue growth has slowed down over recent quarters significantly, but and that's why the stock dropped, as you can see on the chart, and now or that is one of the reasons, and the stock now breaches the 38.2% Fibonacci, which creates risk for deeper correction. On the other hand, if Netflix can keep progressing on those strategic initiatives, the stock can benefit. And also you can see on the bottom of the chart that the relative strength index is close to oversold conditions. And now let's turn our attention to what's ahead. It's a very busy calendar. Starting off tomorrow, we expect a data dump from China. The economy had grown by just 0.8% quarter over quarter in the second quarter, underscoring the sluggish recovery. So it will be interesting to see tomorrow how this evolves. And we also expect retail sales and industrial productions, both of which had improved in August, offering reasons for optimism. Then on the same day, we expect UK inflation figures. CPI has moderated, and the BOE took the opportunity to pause its its tightening cycle after 14 straight hikes. But headline was persistent, and rising energy prices can keep pressure. Of course, inflation is not projected to fall below the 2% target for another couple of years. So the print will be, then tomorrow's print will be a key consideration for the Bank of England. And today's data showed some easing in pay growth, but remains historically high. We also expect inflation from Eurozone. Preliminary figures showed further moderation in both core and headline. And that's pretty much it for today. Other than those, these are some highlights of what we expect ahead, but we also expect more in the coming days. We already talked about Chair Powell's speech. That's on Thursday. We'll talk about it more, and we'll continue to monitor the Middle East conflict, of course. So that's it from me. Thank you for joining me.